Ever feel like the financial markets are speaking a secret language that you're just not in on? Well, guess what? They are. And today, we're going to decode it. We are talking about candlestick charts, an incredible way to actually see the story behind a price move. Let's jump right in.
You've probably seen a chart like this before, right? It looks like a jumbled mess of lines, colors, just pure confusing chaos. It's easy to feel overwhelmed. But what if I told you there's a story hidden inside all that noise?
That's right. Every single one of those little candles on the chart is a chapter in an epic story. It's the story of a battle, a constant tug-of-war between the buyers, who we call the bulls, and the sellers, the bears. It's a language of greed and fear that's been around for centuries, and by the end of this, you're going to know how to read it.
And look, this isn't some newfangled trading fad. The whole idea actually goes way back to the 1700s in Japan. A rice trader named Munehisa Homa figured out that the emotions of traders were a massive driver of price. Fast forward to the 1990s, and a guy named Steve Nissen brought this incredible technique to the West. Now, it's an absolutely fundamental tool for traders everywhere.
Okay, so if we're going to read the market's story, we have to learn its alphabet first. And the most basic letter in this entire language is just a single candlestick. Seriously, understanding its parts is the key to unlocking everything else.
So what is a candlestick really? Think of it like a super condensed summary of what the price did over one specific time period. It doesn't matter if it's 1 minute or 1 day, each candle packs in 4 crucial pieces of information: where the price opened, the absolute highest it went, the lowest it dropped, and where it finally closed.
Let's break it down. Building a candle is super simple. That big, chunky part in the middle, that's the body, and it shows you the distance between the open price and the close price. Those thin lines sticking out the top and bottom are called wicks, and they show the highest and lowest points the price hit. And the color tells the whole story. Green means the price went up, closing higher than it opened. Red means the price went down, closing lower. Simple as that.
And this is where we get into the really cool part, the psychology. A green candle is bullish. Why? Because it tells us the buyers were in control. They were confident and pushed that price higher. A red candle is bearish, showing that the sellers took over and fear or selling pressure drove the price down. It's literally confidence versus fear shown in color.
Okay, so we've got the alphabet down. Now it's time to start forming words, maybe even some full-on sentences. See, when you put these individual candlesticks together, they create recognizable patterns that tell a much bigger, more complex story about what might happen next.
Let's kick things off with an absolute classic, the hammer. This is a single candle pattern, and it's a potential sign that a downtrend might be reversing. Its shape tells a very specific story about a powerful rejection of lower prices.
Think about the psychology here. It's intense. That long lower wick tells us that sellers tried their best to just tank the price. But then, and this is the critical part, the buyers stormed in, fought back with everything they had, and drove the price all the way back up to close near the high. It's the market screaming, "Nope, we are not going that low."
Now, for every action, there's kind of an opposite reaction, right? Well, meet the shooting star. It's basically an upside-down hammer, and it usually shows up at the top of an uptrend, signaling a potential reversal to the downside. It's another story of rejection, but this time, the buyers lose the battle.
The shooting star tells the opposite tale. That long upper wick shows that buyers get really optimistic. They were pushing for new highs. But then, the sellers came in with overwhelming force and just slammed the price right back down. It's a huge sign that the buyers are exhausted and might be out of steam.
So, not every candle shows a clear winner. Sometimes the story is more like a stalemate, a moment of pure indecision in the market. And that moment is captured perfectly by a pattern we call the doji.
A doji looks like a cross or a plus sign, and that's because the open and close prices are pretty much the same. It's the market's way of saying, we're at a standstill. Neither the buyers nor the sellers could gain control. And when you see a doji after a long, strong trend, it can be a huge warning sign that the trend is losing momentum.
All right, I need you to lean in for this part, because it might just be the most important thing we talk about today. Just recognizing a pattern isn't enough. A hammer, or a doji on its own, is pretty much meaningless without understanding the bigger picture. Context is everything.
Which brings us to the million-dollar question. Can you just spot one of these patterns and place a trade? Are they really reliable all by themselves? And the answer to that is a clear, absolute no.
A pattern only gets its power from its context. You need to look at three key things. First, what's the overall trend? Is the market generally heading up or down? Second, where is the pattern happening? Is it at a key support or resistance level, a price floor or ceiling where the market has turned before? And third, look at the volume. Are there a lot of people trading, showing conviction behind the move?
I'm going to say it again, because it is that important. Patterns work best when they are combined with other tools. Think of them as just one piece of the puzzle. They are not the whole picture. When you use them with trend, support, resistance, and volume, that's when their effectiveness really skyrockets.
So let's wrap this up with the right mindset. It is absolutely essential to remember that candlestick analysis is a tool for navigating probabilities. It is not, and it never will be, a magic crystal ball that perfectly predicts the future.
What these patterns do is give us a framework. They let us interpret what just happened in the market, that battle between buyers and sellers, so we can form an educated guess, a hypothesis about what might happen next. The goal is never to be right 100% of the time. It's about trying to put the odds in your favor.
So how reliable are we talking? Well, some studies show that when used with the proper context, some of these patterns can have reliability rates somewhere in the 50 to 65% range. Now let's be clear, that is not a guarantee. It's a statistical edge, and a small edge is completely useless without rock-solid risk management. So here's your takeaway game plan. Use these patterns to identify potential opportunities, not guaranteed wins. Always wait for the next candle or two to see if it confirms your idea. And most importantly, always manage your risk. Remember, this whole explainer is for educational purposes, so please practice this stuff in a demo account with fake money until it becomes second nature.
So, there you have it. You now have the basic alphabet for reading the market's story. You can start to see the battles, the moments of indecision, the shifts in power. That chaotic noise from before is starting to look a lot more like a language, isn't it? So the only question left is, now that you can read the story, what will your next chapter be?